This lesson is going to introduce you to the exponential moving average and a strategy for trading them in trends using the EMA bands. So first of all, you need to understand what is an EMA. What is an exponential moving average? Well, you've already seen what a moving average is from a previous lesson. An exponential moving average is the same thing, except it puts more weight on the more recent price action. Meaning, if you have a 200-day moving average, regular moving average, also called simple moving average, SMA, if you have a 200-day SMA, it will base its average off the 200 days with equal weighting. So day 200 has as much weighting as day 1. The EMA puts more emphasis and greater weighting on the more recent event. So if you have a 200-day EMA, then yesterday, the day before, they will have more influence on the level of the band than way back to day 200. The purpose of this, it is supposed to be faster moving. It is supposed to be more, let's say, more up-to-date or more recent and actionable data. So essentially, it's meant to be used on lower time frames, and if it's used on longer time frames, it's supposed to try and predict or help to estimate trend shifts a little earlier, or trend continuation, whatever. All you need to know is that in certain instances, they provide good confluence for a solid trading strategy. Okay, that's it really. Now, so that's an EMA, but just using an EMA is just an ever-moving line on a chart. You need to have a reason for using it and some value and some edge to actually having this EMA. There has to be something more than just I like the EMA or I want to use it. So first, we'll talk about using two of them together, multiple bands, and using it in the context of following a trend. So as we go through this, what I talk about, and the example I give specifically with the time frames that we talk about, the 12 and 21, it's specific to trend following. So you have to remember that. And then you need to understand about fast and slow moving averages. Okay, this is on all time frames. But if we look here on the chart, I have overlaid the 12 and 21. The green is 12 and the yellow-orange type color is 21. Fast means the lower time frame one. So the 12 in this instance is the fast EMA and the 21 is the slow EMA. All that means is one of them, given that it's over 12 days instead of 21, will be above or below the other depending on which trend we're in, because the more recent price action should have the 12 always above or below. Okay, there are rare instances where they stay compressed and on top of each other for a long time, but that's more rare than you would think. So don't worry too much about that. On some very high time frames, they can stay on top of each other for a little bit. But the simple way of looking at it is, if the 12 is above the 21, we're in an uptrend, and if the 21 is if the 12 is above the 21, we're in an uptrend. And if the 12 is below the 21, we're in a downtrend, like we were here. Okay? All the way down. Okay, so that's what they mean. That's what fast and slow means in relation to EMA bands. Why do they work? They only work because other people use them. There's not really any other reason for it. They're not magic. And like I say on the screen, the time frame is also subjective. I use 12 and 21 because I've used them for quite a while and they work well in crypto and specifically and especially on BTC. But I have also tested the 12 and 21 EMA bands in other markets, in some stocks and in the stock indices like the S&P and the NASDAQ, and they don't work so well. So if you watch this lesson and you think 12 and 21 bands are my secret to becoming a millionaire, no. That is not true. Like anything, they have some value if other traders find them valuable. Simple as that. So they work because others also use them, much like a trend line. You don't want to draw a really obscure trend line that nobody sees, because then nobody's going to put any value in it. It's actually what people think is counterintuitive, but it's actually not. You're trying to follow the crowd. Not every trade, not everything you do has to be going contrarian. So the EMA bands, if you are above them, you're in an uptrend. And so that just simply means don't go crazy on the shorts. And if you're below them, you're in a downtrend. Don't try and buy every dip. The key and the best time to action them is when they cross. So when they go from bearish to bullish, like they crossed here, and like they crossed here, when they went from bullish to bearish, and we had further downtrend. You could have shorted in this area. You could have shorted here, but that was a high risk trade. Shorting there, it's high risk because you're above the bands. Below the bands, with confirmation, you get a much better trade, more confluence. And remember, you might think, well, why, if I could have shorted here, I could have caught a bigger move. Trading is not about catching bigger moves. It's about trading a repeatable, consistent system. You don't make money by hitting massive trades. That's not how you actually grow your wealth over time. You grow your wealth by having many winners over time, hopefully more winners than losers, with solid risk reward and good risk management. And then over time, your portfolio will compound because your portfolio will continue to grow. So that's a bit of a primer, an intro. There are trend following bands, specifically the ones I talk about, 12 and 21. But anytime you use two bands, whether it's a 5 and a 10 and a 20, you're waiting and looking at the point at which they cross to dictate and denote a new trend. So they're 100% trend following. Let me just really hammer this point home. Let me go to a low time frame and pick an example of somewhere like, say for example this. Let's say on a 1 hour, they cross here, bearish, they cross again, bullish, and then they cross here, bearish, and I think they maybe just about crossed again, bullish, all while price just went sideways, because we're not in a trend here on this time frame. On the 1 hour, we were not in a trend, so the bands crossing does not give the same signal as whenever you get the first cross at the beginning of a proper trend, or the first cross at the end of a preceding trend. So they're not meant to hold perfectly. That's the next thing I want to talk about. And it leads into the following point, which is that often losing the bands offers the best trades. So let me explain that as well. Often losing the bands offers the best trades, and they're not supposed to hold perfectly. So as you see in this uptrend, it is true that the first touch of the 12 often provides a good reaction. So as we saw here, the first touch on the 12 offered a nice bounce and a rally from bottom to top, another 7%. Could have caught some nice trades there, sure. That is valid. But what's really good and really useful is whenever they get lost and reclaimed. You have to, and this is very important, you have to wait for the bands to cross bearish before you turn bearish in an uptrend. Yes, there was a big downtrend here, a big down candle, and yes, price was below the bands, so you could say that they were lost. But no, they weren't, because they had not crossed yet. That actually set up a really nice bear trap, and we pumped right through it. Contrast that with the very next time, which is right in here. If you can see, I'll zoom in as much as possible. Right here. The next time, by waiting for them to actually cross, you got a real downtrend. You know, multiple days, this is a daily chart, multiple days of downtrend because the bands had crossed. No bear traps until it had gone significantly lower. All right? That's important. They're not supposed to hold perfectly. So if the wick goes below your 12 or below your 21, don't rush and say the trend's over. Often, it's much like a trend line or even a support level. Price will come to that level that people think is support. Let's say the band in this instance. It will bounce off it, but then they will push it lower because, of course, it's collecting liquidity and there's stop losses there of people who longed the first touch of the bands. And so don't expect them to hold perfectly. And often, if you do lose them, but they have not crossed yet, you can set up some really good trades. So that's why losing is in air quotes here. There's a difference between losing the bands and the bands crossing. This is losing the bands, but not crossing. So losing the bands, but the trend hadn't shifted. This is crossing. The trend has shifted. Okay? In one instance, losing the bands, you can actually look for longs in that uptrend example. In the other instance, the bands crossing, you absolutely do not look for longs. Important thing to note and add to your strategy. Next, always, always, always use them in confluence with other aspects of your system. EMA bands are not magic. If they were, it would be the easiest thing in the world for everyone to be a billionaire. Because if they actually just worked every time, do you have any idea how simple it is to code an automated strategy to buy and sell when the bands cross? It's brain dead simple. You could ask ChatGPT and it would literally make you a script and you could run it now if you'd never coded in your life. So they do not work by themselves. They are not magic. As always, there has to be context to it. And I'll give you context in a second with an actual strategy that I have used and that you can use or you can go and test. One note I want to make here is look at them particularly on the 4-hour candlestick chart. There is a trend and a phenomenon in Bitcoin and in crypto in general that we get moves quite often into the 4-hour close or the 4-hour open. So in particular, 4-hour trend band crosses, 4-hour EMA crosses, tend to produce some nice impulse moves and moves that have a continuation to them. So there's an obvious one here. So we got a strong 4-hour candle. We then traded above that candle for a little bit, and then we got a really strong move up. Where would you have caught that move if you had have watched the 12 and 21 bands? But for the 4-hour, you want to be watching it at 5 minutes to the 4-hour close and 5 minutes after. Often you will spot things, little impulse moves into the 4-hour close and right off the 4-hour open that can give you clues that the band cross is going to produce an impulse. Because the very next band cross was here and it produced an impulse. There was an impulse candle here. It was confirmed on this candle, very shallow to no bounce, and it went all the way down for another 2%, 3% to the bottom in this case. Excellent opportunity for a quick trade, a scalp or a day trade. There are times whenever trends are the ones you want to follow. Meaning there is eventually a time where there is no bounce and price just goes where it's going to go, much like it did here. You see here, the bands tried to cross and they crossed back again bearish, a huge bearish candle, but no bounce in between, and we actually just trended all the way down until it found support. The point of that is to say, observe your H4 closes and opens, and look at how the bands crossing affect other things such as market structure breaks. A market structure break plus an impulse from the bands is a particularly strong signal. So now I'm going to lead into an actual strategy and show you how not just using the bands by themselves, but actually combining them with other factors can give you really strong signals. This is a super simple strategy. And before I go into it, it's not to say that this strategy works every time. It's not to say that it works on every coin. It doesn't. It's just an example to give you an idea of how you can use them. I hope this sparks your curiosity to make you go and disprove the system, not just blindly think Michael's given me the ultimate edge in the markets and I'm going to be a millionaire. No, you should look at this and it should make you curious to see, what Michael just showed me, can I make it better? Can I find where it doesn't work so I can avoid those trades? Can I find where it works better than what he showed me? That's what you should be thinking as you go through this. So let's get into the actual strategy that you can test and play around with right away. Have you ever, I've talked a lot about market structure, and we know what a market structure break is by now from previous lessons. And have you ever seen where you do the left shoulder, then you do the head, but you don't get a right shoulder? Meaning, on an under-over or over-under pattern, which has the market structure break in between, sometimes it doesn't give you that nice retest on the other side, right? Sometimes it looks a little bit like this. You have this level, this candle high before the initial sweep. Then you have the second sweep. So you have the left shoulder, you have the head, if we're using the head and shoulders analogy. Then after this candle closes, we get a confirmed market structure break because it closed back above the dotted red line, which denotes the market structure level. So after this close, from this moment on, we have a market structure break. But to trade MSBs using the typical under-over method, you're waiting for that right shoulder to form. So you're waiting for a move anywhere down into here, all the way as low as this red line, and we don't get one at all. It never pulls back even for a minute. Most of the times you'd be left on the sideline because you didn't get your retest. But look now at the blue circle at how adding the 12 and 21 EMA bands can give you an earlier entry into a trend. The simple way of saying it is this. This is the strategy. The strategy is an incomplete under-over or over-under can often be caught as a trend by using EMA bands. On all time frames, it does not matter. So, what is the strat? 1. Your fast EMA must cross your slow EMA. Okay? Meaning, your green must cross your yellow, and in this instance it's a bullish one, so we want green to cross above the yellow. That is now a market structure break, not a market structure break, that is now a bullish 1221 EMA cross. Secondly, you must have a market structure break present on the same time frame. We've just talked about that. The candle before this had that market structure break. Great. Now, you place an order to go long under the candlestick that confirmed the cross. Meaning, when this candlestick closed, you want to get long on the very next candlestick, and you want to place your stop loss below a preceding candle, so this one, below that low, or, if you want to be extra safe, below the bands. The point of this is that it's not going to come back for a market structure retest, and it's probably not even going to touch the bands until much later. So it allows you to define your risk, which is essential for any strategy. It allows you to get a better entry, and it gives you early confirmation of a trend shift. Because one of the key ways a trend shifts is when moving averages cross in the opposite direction. You then have double confirmation. In fact, you've actually got triple in terms of 3 factors you'd like to see, but double confirmation in that you have a market structure break, confirmed, that's 1 bullish move. Then you have a bullish EMA cross, that's 2. So there's double confirmation. That immediately makes your strategy more robust. And the third thing you have, which is really great, is you have sideline traders. You have all these people waiting for the retest that doesn't come because it's been front ran. So by adding this in, you can potentially find some nice quick trend moves whenever other people are sitting waiting for their underside retest. And that's it. That's the strategy. So take that, check it on different time frames, draw them up in the charts, go back test them first, look through different coins, look through different time frames. Where does it work well? Where does it not work? How can I make it better? You can take all these things and you can build upon it. But using these bands, you can help to identify trends. Okay? So that's the strategy. And finally, I'll summarize, finish with a summary. When you look at any trend, if you have these bands on, they don't have to be 12 and 21, I just want to repeat that. All you should be doing, even if you don't trade using them, is having them on so that you know broadly where we are in a market trend. If you have them on, you would have known not to short any of this because we're above the bands. You would have known not to short this because we're above the bands. You would have known not to short this breakdown because the bands hadn't crossed. So then when this pump wrecked everyone else, you wouldn't have got wrecked. You would have known that shorts were valid in here because the bands had crossed. Okay, you understand how much power that adds. Trading is not all about making perfect trades. A lot of it is about avoiding bad trades. And just having the bands on any time frame, can help you with that, avoiding bad trades and spotting opportunities where your other factors like market structure, whether any other factor, maybe you're a momentum trader with RSI, maybe you trade whatever price action, Wyckoff, it works with everything. The bands simply denote what type of trend we're in, up or down, and let you to get better entries and avoid bad trades. So that's the lesson, finished with a strat on 1221 EMA, and specifically about how EMAs help you to trade better.